your roadmap to the latest in auto. Welcome to Highway Herald. Buckle up, gearheads. We're diving into a power play that could shake fuel prices, EV adoption, and America's energy future. For years, the US has ramped up oil production to reduce foreign dependence, but OPEC isn't backing down. Through production cuts and strategic alliances, they're keeping control of the global oil game. What does this mean for drivers and automakers? Let's break down 7 critical OPEC moves and their impact on the US and global auto industry. Number 7. OPEC's strategic chokehold on supply. December 2024 saw a major power move from OPEC Plus as they extended production cuts through Q1 of 2025, postponing any plans to ramp up output until April. The reason? Weaker than expected global demand and a surge in oil supply from non-OPEC producers like Brazil and Argentina. By keeping supply tight, OPEC isn't just stabilizing prices, they're steering the global energy market. This move challenges America's rising oil production, which the U.S. Energy Information Administration, EIA, estimates will reach 13.59 million barrels per day in 2025. For U.S. consumers, this means fuel prices remain under OPEC's control, affecting industries dependent on oil and influencing vehicle sales trends. Higher fuel costs often drive demand for hybrids and EVs, while lower prices keep SUVs and trucks dominant. The stakes? The future of America's energy independence. Number 6. Saudi Arabia and Iran, from rivals to allies. If you've been following Middle Eastern geopolitics, you know Saudi Arabia and Iran have long been rivals. But in a surprising turn, 2023 saw them sign a renormalization deal in Beijing, easing tensions and strengthening OPEC's unity. For the US, this newfound alliance is a game-changer. A more coordinated OPEC means tighter control over oil prices, making it harder for America to steer global energy policies. With Saudi-Iranian ties improving, OPEC is more powerful than ever, forcing the US to rethink its diplomatic and economic strategies. But what about the EV revolution? The stronger OPEC becomes, the more Western nations may accelerate their shift to alternative energy sources. Could this geopolitical realignment fast-track EV adoption, or will OPEC's control continue to dictate the energy landscape? The next few years will be crucial. Number 5. How OPEC is driving up oil prices. Brent crude prices are expected to reach $74 per barrel in early 2025, but analysts anticipate a drop to $66 per barrel by 2026 due to rising production outside OPEC and slowing demand growth. However, OPEC's firm grip on supply is keeping fuel prices high in the meantime. For the average driver, this means higher gas prices, increased transportation costs, and a ripple effect across industries. Even if you don't think fuel prices impact you, they affect everything, from shipping and logistics to the cost of everyday goods. While U.S. oil production is on the rise, it's not enough to fully insulate the country from OPEC's influence. Whether you're behind the wheel of a V8 muscle car or an efficient hybrid, OPEC's strategy is still hitting your wallet and shaping the future of fuel costs. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to create more content like this. Now let's explore number 4, the refinery bottleneck that keeps the US dependent on OPEC. Here's something most people don't realize. Despite all the talk of US energy independence, there's a fundamental mismatch in the American oil industry. While US refineries were built decades ago to process heavy crude, the country primarily produces light, sweet shale oil, which isn't always compatible with its refining infrastructure. This means that even as the US pumps record amounts of oil, it still relies on OPEC nations for heavy crude imports to keep refineries running efficiently. Adjusting refinery configurations to process more light crude would require massive investments and years of restructuring, a shift that hasn't yet materialized. For now, OPEC still holds a key advantage, keeping the US partially dependent on foreign oil. Until refineries adapt, the country's path to true energy independence remains more complicated than it seems. Number 3. OPEC's calculated long-term strategy. The US often takes a short-term, market-driven approach to energy, reacting to price shifts with rapid production increases. Meanwhile, OPEC plays the long game, strategically managing production levels and spare capacity to maintain stability and control global oil prices. This calculated planning allows OPEC nations to predict revenues, adjust economic policies, and respond to market fluctuations with precision. In contrast, America's reactive strategy may deliver quick economic gains, but lacks the long-term resilience OPEC's approach ensures. For the U.S. to strengthen its energy security, it must move beyond short-term drilling booms and focus on sustainable policies, infrastructure investments, and stronger international partnerships. Without a long-term vision, OPEC will continue to dominate global oil markets, forcing America to remain at the mercy of foreign energy decisions. The battle for control isn't just about production, it's about strategy. Number 2. How the world is adapting to OPEC's influence. OPEC's strategic moves don't just impact the U.S., they ripple across the globe, forcing oil-dependent nations to rethink their energy strategies. Countries like India and China are ramping up renewable energy projects and overseas oil investments to reduce reliance on OPEC-controlled supply and hedge against price volatility. Meanwhile, Russia faces mounting challenges. As of February 2025, sanctions and infrastructure disruptions have severely impacted its oil industry. U.S. restrictions on Russian tankers have stalled exports, while drone strikes on refineries have cut refining capacity by 10%. This has left Russia with an oversupply of crude, but fewer ways to move it. With Russia's production declining and global markets shifting, some nations are adapting while others struggle with economic instability, all as OPEC continues to shape the energy landscape. The battle for control is far from over. Number 1. The U.S. response, caught between strategy and reality. As OPEC tightens its grip, the U.S. faces mounting energy challenges. While shale oil production has been a powerful asset, the current global energy landscape requires a more strategic approach. U.S. President Donald Trump has pushed for sanctions on Russian oil, urging Saudi Arabia and OPEC+ to boost production and drive prices down to weaken Moscow's economy. But OPEC isn't cooperating, citing weak global demand and financial risks. At home, U.S. shale producers aren't on board either. Despite pressure to ramp up drilling, oil executives prioritize cost control and investor returns over volatile production increases. While U.S. oil output is projected to reach 13.59 million barrels per day in 2025, it won't fully shield the country from OPEC's influence. The battle for energy dominance isn't just about production, it's about strategic positioning and global alliances. What's next? The future of energy on a global scale. OPEC's strategic moves have reshaped the global oil market, reinforcing its dominance and pushing nations to rethink their energy policies. For oil-importing countries, the challenge is clear. Diversify energy sources, invest in renewables, and reduce reliance on OPEC-controlled crude. For the U.S., securing energy independence requires a balanced strategy, boosting domestic production while managing output, strengthening ties with non-OPEC suppliers, upgrading refineries, and accelerating renewable energy investments. While America remains an energy powerhouse, OPEC's stronghold on supply chains keeps the battle far from over. Will OPEC's grip weaken as renewables rise, or will its influence continue to shape the market for years to come? Drop your thoughts in the comments. Before you go, subscribe to Herald for the latest in automotive news and energy trends. Thanks for tuning in. See you in the next one.